Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. It's Halloween, the day after a long-awaited budget that perhaps wasn't quite as terrifying as many feared. But make no mistake, this was a significant event. £40 billion worth of tax rises, a big focus on investment, a notable loosening of fiscal policy relative to previous plans. We'll have much more on that and on the impact on gilt yields and even base rates in the days ahead. Today, though, we are focusing on the personal finance changes, a raft of measures announced, changes to CGT rates, bringing pensions into the IHT regime and other points, all of which we'll get to shortly with our personal finance editor, Val Cipriani. There are, of course, shares to focus on as usual. In terms of share prices, the initial reaction was positive, with increases for pubcos, some property companies and so on. There were also plenty of relief rallies, oil and gas stocks, and in particular AIM businesses, investors seemingly thankful that the IHT relief has effectively been halved rather than eliminated. So later in the show, we'll be discussing one of the biggest companies on the AIM index, and one that's had a very tough year, pretty much of its own making. That's pollster and data analytics business YouGov, whose trading update the other day was a bit better received. Mark Robinson is here to talk about that. In between, we're also going to look at HSBC, which announced a significant reorganisation the other week and reported Q3s the other day. Julian Hoffman is with us to discuss further. Val, let's get straight into the budget, though. There's a lot we could talk about here. We've talked a lot online and in print, as I'm sure readers and listeners will have checked out already, if not with us, with someone else. But let's start with CGT, because this has been a long-trailed change, and perhaps it's the simplest to begin with. What are the increases to the rates, in short, to begin with, and what are the possible implications, maybe, of the changes announced yesterday?
Yeah, as you say, it is in a sense quite straightforward because it's already come into effect from yesterday. So there is only so much that people can do about it, really. And so the sort of lower rate of CGT has increased from 10% to 18%, and the high rate has been increased from 20% to 24%. I think the main consequence there, or the main notable thing there, is that shares sort of lose their advantage over property because the rate of CGT has stayed the same for residential property, whereas it used to be lower for shared, and now they are at the same level. And so, well, at the most basic level, it just means that it's even more important to try and invest using ISAs and pensions, because obviously CGT does not apply on anything you may have in there. So just kind of like making the most of your allowances. And then the other thing is that there is a smaller difference between the basic or lower rate and the higher rate now, which again does not change the rationale of things massively, but there used to be a bigger advantage on doing things like, for example, transferring some of your holdings to, for example, a spouse who might be on a lower rate of income tax and as such pay lower CGT rate, or even things like realizing your gains, so selling your assets over numerous tax years. Because basically the way it works, and the reason why I sometimes call it just the lower rate rather than the basic rate. So if you're a basic rate taxpayer, it doesn't mean that you always pay CGT at the lower rate. It means that until your gains hit the threshold for which you still remain a basic rate taxpayer, you do, and then on anything above that, it becomes the higher rate for you as well. So there is kind of like a less advantage into trying and sort of work around this kind of thing. But then the difference between the two does remain.
Yeah, as you say, that increase from 10 to 18 is quite significant. Typically, there's a lot of retirees who, in a lot of cases, will have some gains to crystallize, who will be basic rate taxpayers. So that's significant for them. Likewise, people transferring assets between spouses, one of whom might be basic rate, one of whom might be a high rate payer as well. These are significant things. Let's move on to pensions straight away then, given we mentioned retirees. Bringing pensions into the IHT regime was again something that had been speculated before the budget. I mean, almost everything, every personal finance change there is had been raised, it seems, at some point before the budget. But this is one that is going to happen. That hasn't happened straight away. It'll be 2.5 years when that does happen. But again, this could result in, it is quite a significant change, and therefore could result in a lot of different behaviors and has a lot of different implications as well.
Yeah, 100%. So, yeah, it definitely could have been worse, couldn't it? There was a point where we thought some quite big changes to pensions, like pensions tax relief or the tax-free cash, would come, and then that would have been, I guess, also much more politically complicated for the government and the chancellor to handle. This is a relatively easier one in a sense, but it does not mean it will not have quite big consequences for people. So the first thing will be that when it comes into force in April 2027, a lot more people will pay IHT. And this will be due to both the fact that pensions are included, and it will also be due to the other big changes in IHT, which were announced yesterday, and that is that the tax-free threshold will stay frozen until 2030. So basically, the tax-free threshold is 325,000 and can increase to 500,000 per person if you're passing on your home to your children and grandchildren. And until your estate is within that threshold, you do not pay IHT. So what happens if that threshold stays frozen for longer is that the real value of that threshold is lower, and as such, a lot of people, as property values and asset values go up, a lot of people go above the threshold. So between those two changes, by 2030, inheritance tax used to be very much a sort of rich people tax, and now it's considered a lot more of a middle class kind of thing, and that will get worse inevitably, especially again. Property prices are a big thing in this. So that's one thing. And then the other one is that the sort of bringing pensions under inheritance tax umbrella does mean that planning to try and minimize that tax becomes more difficult. Because that used to be one of the main options. Advisors will tell their clients to try and use up their pension assets last. And prioritize things like ISAs, because ISAs are subject and have always been to IHT, and pensions were not. So if you wanted to try and reduce your liability, you would try and not touch your pensions. And obviously that doesn't apply anymore, and so you're left with not a lot of options really to try and reduce the tax. Mainly you can try and give away some money during your lifetime, including potentially taking it from a pension and then take advantage of the various giving rules, the most basic of which is that if you give away something and then you leave for 7 years, that money is no longer part of your estate, so IHT doesn't apply. And so this is quite a long way to say that there will be even more thinking about how much you can afford to give away and how much you need to keep for yourself. So, like a balance between try and reducing IHT and also having enough money to live very comfortably, basically.
We were just talking about this before we came on air, actually. The gifting does seem almost certainly like it will increase. There were rumours that the gifting limit would, the opposite of a limit really, would change from 7 to 10 years, i.e. you had to live for 10 years before things were free from IHT. But a combination of perhaps that being something that could change in future and the fact that pensions are no longer going to be free of IHT might encourage more people to look at gifting. As you say, that balance is the important thing, though, isn't it, between making sure you don't run out of money and giving money to your descendants, because people do still think they will live for less time than they invariably do, so it is a risk. I think we see this in the OBR figures as well, though. The amount that these changes, or this particular change, is going to raise does decrease as the years go by, because behaviours naturally change to account for it. The other interesting thing, perhaps, on this particular shift is coming down the line, we've potentially got quite an administrative nightmare for pension scheme providers, or more to the point, for people dealing with the estates, because it seems from the early guidance that government is putting the responsibility on scheme providers, things like that, to sort out the IHT based on the fact they have to administer, drawdown, etc. But personally speaking, my faith in the ability of these companies to be able to do that in a prompt way isn't very high, and I suspect that might be a risk.
Yeah. So we've had some comments already to that effect from experts. So the government has launched a consultation about how to sort of make this work, and the preliminary stuff that has been put out does not seem to inspire experts with loads of confidence. So some people are suggesting that it could become quite complicated for grieving families because they basically will need to work out exactly, the various different pensions that someone had when they passed, how much they were worth, whether IHT applies, and then IHT needs to be paid before they can get access to this pension money. So it could potentially be many months before that happens. It's still very much in the making. And it is good that the change has not been brought forward immediately, because it does give some time to the government and to the pension industry to try and sort it out, which is good, because always pension changes of any kind they tend to be just way more complicated than people initially think, because it's such a complex system. But even then, for now, it is looking like administratively and bureaucratically it could be quite complicated. And let's not forget that there are already right now delays on basically obtaining probate, which you need to sort out IHT and a person's estate. And that has more to do with the courts side of things. But even then, it's already like a sort of time-consuming, quite stressful area for families. It's not looking like this is going to make things easier, basically.
We said at the top that you correctly pointed out that CGT on shares is now aligned with additional dwelling CGT. But if you're thinking, therefore, the property is more attractive, there are other considerations from this budget. Stamp duty in particular has changed for, again, additional dwellings.
Yeah, so basically that means that if you buy a second property or an investment property, you are going to pay stamp duty at a rate that is 2 percentage points either, so 5%. And we talked a number of times about how buy-to-let as an investment has been on quite difficult grounds for some time due to a number of changes, due to the fact that interest rates are higher, so it's just less profitable. And again, this is quite a significant change in terms of hitting profitability of an industry that is already necessarily not doing so well. And there are some questions in terms of whether it will hit the supply of rental homes. On the other hand, obviously, if you're a first-time buyer or anyway somebody who's looking to buy a place as your own main residence, you have a little bit of an advantage compared to investors, compared to what it was before, basically.
There are, of course, many other aspects to this budget. A lot of them we will look at next week on the podcast and, of course, online and in print as well. But let's run through a couple of the other personal finance measures, perhaps, because one thing that hadn't been previewed, or rather had been previewed in the opposite direction, had to do with the income tax thresholds. Can we say what happened there? And also, sort of related, the freeze on the ISA subscription threshold.
Yeah, so income tax, we got a bit of a surprise because so income tax thresholds have been frozen since 2021 by conservative governments. And that's basically a way of raising income tax in real terms without actually raising the rate of income tax, right? Because wages go up, but the thresholds stay the same, so more and more people pay higher rates, and the Treasury raises more revenue. And that's what we normally call the fiscal drag. It has been discussed a lot. I think Labour in the past also called it a stealth tax, and so on and so forth. So they're meant to stay frozen until 2028. There were quite insistent rumors that in the end the Chancellor might prolong that freeze to 2030, so another 2 years. And it would have been, I think, quite difficult for them to argue that they kept the promise not to increase taxes on working people if they did that, because that is quite obviously touching income tax. even though it's not explicitly the rate of income tax, but in the end the effect is sort of the same. And instead they just decided not to do it. So income tax thresholds are gonna start going up again from 2028, basically, which again is good news. And I think part of it might be motivated. So there is an issue with the state pension because obviously Labour is committed to the triple lock. That means that the state pension goes up significantly every year based on basically either inflation or earnings. So right now it is getting quite close to the level of the tax-free personal allowance. So it is expected that within relatively small amount of time, depending on how inflation behaves, it will breach that level. So if the personal allowance doesn't go up again, people who receive the state pension are going to have to give some of it back in income tax, which would be A, weird, B, administratively quite complicated. So there might have been, like, it was quite a big topic of discussion a few months ago, so there might have been something about that in that decision as well. And then, yes, as you were saying, some small bits of ISA news, which could be, I guess, could be seen as good news or bad news, depending on how you want to look at it. So it's good because we are keeping the ISA allowance until 2030, and it's obviously a huge thing for investors because it does mean that they can invest their 20k a year without being hit by CGT and dividend tax on the money they invest. It is also somewhat bad news because those 20k have been at that level for quite a few years, I think since 2017, and the fact that we'll not be increasing until 2030 again does mean that the real value of that allowance is going down significantly over time. So yeah, depending on how optimistic you were feeling on this, it might be good or bad news. And then finally, the much discussed British ISA is not going ahead. So that would have been potentially an extra allowance for investors just to invest in British share, but still extra allowance that is not happening.
Yeah. We've spoken about the fate of the UK, the British ISA before, haven't we? But the ISA allowances, there were quite big increases, I suppose, in the 2010s, but there is now a long period of them being frozen. But again, in the context, perhaps like much of this budget, of concerns that something else could have happened to ISA allowances, the fact that for now they are staying as they are is good news. We'll come to the other big personal finance change in relation to AIM shares later on in the show. You can now get 12 weeks of an Investors Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information. We're going to talk about HSBC now, which has had a big reorganisation, a big rejig of its own, as we said at the top in recent weeks. Julian, can you put this in context? Because for a while now, there's been a lot of talk about the structure of the bank, the way it's perhaps being pulled in different directions. What can you tell us?
It was an interesting update in many ways. Partly, at least initially, the market welcomed it. George El-Hedri, who's the new chief executive, was widely expected to completely reorganize the bank. That was part of his pitch when he took the position. There was a general feeling that HSBC was just too big and too sprawling, really, to fully realize its profitability. And there were all those discussions anyway in the background. So what he actually came up with, though, was a solution which perhaps in the view of some of its shareholders was what it had rejected before, which was a kind of split in the bank between East and West. And it actually, interestingly, took a couple of days for people to cotton on to really the implications of what he was suggesting. They're basically merging what are currently global segments for the bank into much smaller regional divisions almost. So, for example, investment and corporate banking is going to be merged, and half of the clients who are in will be run out of London, and the presumably Asian clients will be run out of Hong Kong, which in broad terms is more or less a structural split. But given the vehemence that HSBC has come out and attacked anyone who's suggesting that this is a Trojan horse for a breakup of the bank, whether that turns out to be what it ultimately does is open to question. But certainly in certain respects, it is responding to the criticism of people like Ping An, who are the Chinese insurers and HSBC's biggest investors, that HSBC had to start to reflect what is now a growing and recognized global reality, that we seem to be breaking up into trading blocks rather than having this kind of unfettered global free trade. And perhaps this reorganization is just an acknowledgement of that reality.
Yeah, there's been that pressure for a long time, hasn't there? And perhaps, as you say, the vehemence of the denials reveal more than intended.
Yeah. I mean, if it looks like a duck and it quacks like a duck, and it's probably a duck, isn't it, in that sense? But I mean, his pitch, or George Elhedery's pitch, really is that this reorganization will generate cost savings. The initial figure that they bandied around was 300 million. This would come from cutting senior positions in the kind of merged divisions. He's also cutting the supervisory board of the bank down to 12 from 18. So there will be a kind of like merging of responsibilities. But importantly, they didn't actually confirm what that would generate. So they're not going to do anything about quantifying the savings from this move until 2025, or at least probably until the next full year results in February. So it is a little uncertain at the moment. They kind of left it quite open, which is why people have filled that gap with speculation. So yeah, in a sense, we don't really know for 100% what how this is going to help HSBC's business in terms of generating savings, and whether that will come back to shareholders in some way.
Yeah, they seem to. They've said that the annual savings will be greater than the upfront costs, I think, and that it should be a quick turnaround for these cost savings. But you're right; they've held off providing the specific detail for a while longer, which might suggest they're not quite sure themselves yet either.
And that is, I kind of think, worried people a bit, that they've gone and given people the ammunition to say that this is actually a disguised breakup. That he's doing the bidding of the larger shareholders. They're thinking about that first and the cost savings later. I think that's the impression that's been left.
There's another outstanding question over the Mexican banking arm, which is probably the biggest, I think, offhand, outside of the UK and the Hong Kong businesses, which clearly doesn't fit into either of those two categories. And given the way they've hived off and sold various international retail banking businesses, this is much bigger than those, but might be something in future that might seem to be on the block based on this new reorganization as well.
Yes, that could be, as you say, the next. It is something that seems to sit outside the block, and they are concentrating the businesses either on very mature markets like the UK and Canada, a little bit in North America, and what they view as upcoming maturing economies in Asia. So yeah, they've already got rid of Argentina, which was a relatively small part of the overall business.
Let's talk about the Q3 figures themselves, which came out the other day, because in terms of how the bank is actually operating, clearly they were quite enlightening. It seems very much that the wealth arm is still driving things at the moment. The figures were pretty good, and wealth in particular is still really growing at a very strong clip.
It is, and the wealth arm is an Asian business, which, or at least it's generally slanted towards customers in China, Hong Kong, that region. So that gives you some indication of where the real growth is coming from. It is operationally doing very well. You can't dispute it. I mean, they produce 8.5 billion of pre-tax profit on 17 billion of revenue. I mean, that's a pretty good result in anyone's book. The thing that the problems that they might run into is that we still don't quite know where the impairments are in terms of its exposure to Chinese property. They say that this is falling. There is some evidence that the property market in China has reached some kind of floor. So their expected credit losses are only in the range of 30 to 40 basis points at this point over the medium term, which is a better result than most people have forecast. But the problem with that figure is that banks tend to mark their own homework when it comes to credit losses. It doesn't really, if they're practicing extreme forbearance or whatever on loans, then you can more or less decide what that figure is yourself. But yeah, so apart from that sort of uncertainty, the Q3s, they led to another big buyback. They're buying another 3 billion of shares. That will make 9 billion for the year. And the return is pretty attractive. So you're looking at 7% just for the dividend on its own, and that rises to over 10% when you add in the buybacks. So it's a very, you can say it's at the moment it's an operationally attractive business, but with a kind of strange, uncertain future when it comes to how it will look in 2 or 3 years' time.
Yeah, and maybe a final thought on the net interest income outlook, because clearly that's been a big driver for most banks over the past couple of years, with base rates being higher. Now we're in an environment where base rates are falling. HSBC, like most banks, has some hedges. How was the net interest income looking and the guides looking in this update?
So they think it's still coming in the mid-teens. So it's not, or the growth will be in the mid-teens, which is where most analysts have put it. They've hedged, I think, about 30% of the book. So, and that will kick in over the next couple of years. So they should actually, I think, the outlook is relatively stable despite the fact that base rates are falling. And I think investors are not going to see much difference to the NII figures and before 2026 onwards. I think it's going to be there'll be a slightly different story, but they are rapidly substituting lower yielding securities in their hedge for higher ones. So the hedging income is going to only increase over the next 2 years. So I think the picture in at least in the short to medium term is all right, but in the medium to long term, that might be a different story.
We're going to conclude on an AIM share, as mentioned at the top, YouGov. A bit of context before we get into it, Mark, because they had their own trading update the other day. But AIM shares yesterday, the AIM 100 was up 4% on the halving of the IHT relief rather than the scrapping. The implication being the worries there were that would go completely. YouGov itself has had a good run before that because of this trading update. In the short term, that is, its shares are up 25% over the past week, which is quite significant. But this is all in the context or the shadow of the big profit warning in June, which knocked a third off its value, really quite significant. We'll get to that in a moment, maybe in the context as we carry on. But what did the trading update say in the near term about the business? Because this is a year of many elections, as we know, as we've been told many times, and on the surface, people might think YouGov is a company ideally positioned to exploit that, but I think its struggles issues really show that it's a different type of business in many ways.
Yes, it's evolved into not a completely different beast now, but it has its genesis going back to just the post-dot-com boom era, when it got a sort of a digital lead on some of its rivals, like Gallup, for instance. It was one of the first to really initiate digital systems to those large data sets, whereas before, political polling was a physical, somewhat arduous and expensive process. And so they got the march on their rivals in that regard. But it may well be a case now of a disruptor being disrupted itself, and that's primarily because of the rollout of AI and the potential for dislocation in that market that might bring too. I think these results were reasonably well received, but there were some positive points. The revenue was slightly above expectations, but I think possibly the most positive aspect was the growth in the Americas as well. In that market, hasn't been B2B spending hasn't been impacted to the same degree as it has in the UK and Europe. And so that might provide a slightly better window on the potential for YouGov's business going forward. I think management referred to this series set of results as transformative. It's a sort of a overused term, but in this case, I think it's apt, and it's not just because of what happened during June, but also because of the acquisition they made at the beginning of the year of the consumer panels services business of GfK, a Nuremberg-based business, which has positioned them to take advantage of changes in the digital world, and a post-period acquisition as well, Yabble, a New Zealand-based firm, again with an eye on the expansion in the industry through predictive AI. So yeah, I think there was a lot of bad news sort of in the share price. It went down by about 38%, I think, at one point. So it was a hell of a hit to the company itself. I think the focus now for investors is just how quickly that Nuremberg business gets bedded in. There was a steep increase in administrative costs this time around. You would expect that in the first year or two after acquisition. But I think the company is wary of the fact that some of these costs could become embedded central costs, which would be a worry. So they've gone out of their way to implement a rationalisation program, which it is hoped will generate about £20 million of annual cost savings. It's a little bit too early to see how that's going at the moment, and it will invariably entail some fairly significant job losses too. So, the thing is that there's obviously been changes in senior management of the company too, but I think management would have attracted even more criticism had they done nothing at all. I think their hand has been forced in this. We still don't know what's going to happen for these type of B2B services, data services too, because there's every chance that AI technology will be increasingly brought in-house amongst retailers and any companies that rely on large data sets too. Management at YouGov tend to think this is overplayed, and they see the main strength of the business is their existing data channel, vast data channels too. So I guess we'll get a little bit better idea of the company going forward when we look at the next interim and the next full year results. Interesting times for them, though.
Yeah, I mean, they do. Well, just to start with the shares, they are still down 60% year to date, even with this rally. So there's a long way back, and the data aspect is clearly what they're relying on. That move into the Americas is going to be a big push for them, but they do still rely on getting data from other people, sometimes from big tech companies as well. And I think the cost of that has gone up too. That's a small part of the overall cost base, as you say. You address some of those other points, but it seems as well there are other issues there with the data products division as well. Has been seeing, I think they've said that's their subscription service. That's been seeing increased competition from some of those companies, non-listed companies, but big companies nonetheless, who in previous years they seem to have lapped to, are now making a bit of a comeback. So that's a bit of a concern for them, it seems, as well. Also, when we look at next year, that data products division is, I think, a quarter of profits as well.
It's not seen as the growth portion of the business as well. So
I think it's certainly been growing strongly until this year when it's come off, and now they're perhaps looking elsewhere. But it could be a big burden, or personally I think it might be. But the other interesting thing was when we look at next year, and because of course the focus is always on the future, they're more optimistic for next year, as you'd hope. But even then, things are going to be quite second half weighted. So it's going to take some time for all these changes to play out, it seems.
Yeah, it would be unrealistic to expect any sort of rapid turnaround. It is a hefty acquisition in terms of their market cap too. The switch is definitely, I think, towards a more bespoke, complex data analysis from their perspective. Hence the move into AI. It's been forced upon them. But I do think that result in the Americas does give encouragement to shareholders too, because it might actually be a pointer to the where demand is headed. Things have been so flat in B2B services in Europe, as we've seen in other sectors too. So yeah, I made a couple of notes of valuation at the end there, and the one thing that stood out, their forward multiple, isn't extravagant, and they traded a 1/3 discount to the target price. Not that usually means that much, but their price earnings growth ratio stood at 0.7 times, which under normal circumstances could point to an undervaluation of growth potential in the marketplace. You could always say that's a realistic application on the part of investors too. But I think it would be hard to draw too many conclusions about the company at this stage. We've got to just see how that integration process works. And 2 years down the track, who knows, we might be pleasantly surprised.
There's no doubt, in fairness to them, that consultancy services, as you say, have really struggled this year in general. There's been less demand for them. So that America's side of things, as the US still being the driver of the global economy, is clearly where they have the best chance of succeeding and getting those growth rates back up.
And the cost of capital is going to fall. Well, presumably the cost of capital is going to fall over the next 18 months, which has been a sort of load on business at this end of the spectrum as well.
And perhaps the certainty of the AIM market relief still being there in some form might provide a tailwind too. We'll see.
Yeah, definitely will. But as I say, a year and a half from now, we'll probably come back to the subject, I think.
Well, perhaps for all these reasons, we have them on hold at the moment. But you can find out more about YouGov and many other AIM companies next week in the second half of our AIM 100 special, which we'll be discussing on next week's show. For today, though, we have come to the end. We have run out of time. So thank you very much to Mark, to Julian, to Val, to our producer, Maddie Apthorpe, and to you for listening. We'll see you next time on another